Hello, my name is John Combs. I am a securities entertainment attorney. I was in Los Angeles for about 23 years working with low budget independent filmmakers, handling the securities compliance for their offerings to investors. So, the underlying assumption here is for this discussion of independent film financial projections is that we are selling a security. In other words, our investors are going to be passive, not involved in decision making. And so what we're looking for is a reasonable approach to preparing financial projections for independent film offerings. Now, I'm not going to go into too much detail on my bio because we have a limited amount of time, but my bio is available at filmfinanceattorney.com, which is my website, and it's all there in black and white. So take a look. Uh, and I have a lot of other information on the website that I think is useful to independent filmmakers. Now, what's the purpose of financial projections? People burden themselves unnecessarily with the idea that financial projections is an attempt to predict with certainty how a film is going to perform in the marketplace, and that's an impossibility. So we need to get rid of that concept. It just puts too much pressure on you. A more reasonable approach would be to make a reasonable projection of the possible, and note I didn't say likely even, but the possible economic performance of an investment in an independent film offering. So that kind of helps us relax a little bit and not put so much pressure on ourselves trying to predict with certainty. Here's another distinction that's important. You all know what box office comparables are, and we're talking today about financial projections. So, are they the same thing, or are they related in some way? They're two different things, but they do relate. And I've seen people combine them and treat box office comparable as simply one element of a financial projections presentation, and that's okay. I try to keep them separate because they are two different things, and I put the box office comparables in the main body of the PPM, and the financial projections I treat as an exhibit. So, but uh, these two things are different, but they do relate. So we'll talk about that. Box office comps look at the performance of similar films in the past. So the producer of the current film is saying, okay, here's a list of films that we think are similar in genre and budget to the film we're proposing. And the underlying assumption there, even if it's unstated, is that, well, if our film does as well as the average of these comps, then this will help us develop financial projections. Now, projections themselves, though, look at the future potential performance of your film, your current film. And so comps looking in the past at other films and projections looking to the future of your single film. Now, here is an example of box office comparables. Um, and I don't want you to pay, I mean, there's no need in paying attention because this is an old chart, but I'm just showing it to you to give you an idea what a format might look like for box office comparables. And so I start off over here on the left side with all the titles of the films that we think are similar to our current film. And, 10 or 15 would be great. Sometimes with low budget independent films, certainly unique and unusual low budget independent films, it's difficult to get that many, but a nice sampling of films over the years that you think are similar to your film or the proposed film in terms of genre and uh, the budget. So the next column is year release. Now, a lot of people will try to go in and put in the exact date of release. That's kind of irrelevant here, and it takes up too much space for both a slide and a chart if you're using it in your PPM. So I just put the year released, and I try to do it in chronological order because it seems orderly to me. And I also, here's an important column. The third column is distributor. There's a big difference between a film that's released by a major studio distributor as opposed to an independent distributor. So, and investors, you ought to let your investors know that. If you're comparing your film to a major studio release, at least disclose it. So the distributor column is important. Then the reported budget, I don't just say budget because you really don't know whether you can trust those numbers or not All you can say is, well, this is what was reported in the trades or in the services that provide these kind of numbers. And so I put reported budget. And then the final column is some sort of performance number. In this case, it was worldwide gross. Uh, that's what this producer chose because that's the information they had. It could be domestic box office, which is the number that's more readily available, or it could be domestic gross, any of those numbers. But the key is that the numbers should all be of the same category. They should all be worldwide gross, or all be domestic gross, or all be domestic box office. That way, then you can add them all up, divide them by the number of films, and leave out a couple of top performers if you want to, and come up with an average that might be useful as an assumption for your financial projections. And so that's how box office comparables relates to financial projections. You come up with an average based on a reasonable selection of similar films, and that's can be used as an assumption in your financial projection. Now, there are a lot of myths floating around in Hollywood about all kinds of topics, including film finance and certainly investor financing of independent film. And one of those myths is if you include financial projections with your PPM, you'll be sued. I was confronted with this particular myth one time when I was a member of a 3-person panel discussion before the entertainment attorneys of the Beverly Hills Bar Association in Los Angeles. And on my left on this 3-person panel was a prominent entertainment attorney who works on film deals, film finance deals much bigger than I do. And on my right was a securities enforcement attorney for the SEC, the Securities Exchange Commission. And so we're taking turns talking about various aspects of film finance and securities compliance and so forth. And at some point, an entertainment attorney in the audience stood up and asked the question, if we include financial projections with our film finance, or should we include financial projections with our PPM? And the entertainment attorney on my left got agitated and said, well, no, don't do that. You'll be sued. And that is contrary to my experience. So it left me in an awkward position of either potentially embarrassing my friend, the entertainment attorney, or telling this audience of entertainment attorneys the truth. And so, as you know me, I opted for the truth and told them the same thing that, I've done hundreds of these types of film offerings to investors, and most of them included finance projections, and nobody has been sued. So I then had to go on and explain that the SEC actually has, and this is something a lot of people, I should say, in Hollywood do not know about because they don't really deal that much with investor financing, and therefore they don't have to be confronted with securities compliance. But basically, they're saying that the SEC has a policy about financial projections. In other words, they give you some guidance on how to do it so that you won't get into trouble, be sued. And so we'll take a look now at what that policy is. Is a little quick summary of the SEC's policy with respect to financial projections. So let's preface this by saying if you're conducting a securities offering, and of course, as we already know from other videos that we've done, if you're selling units or shares or whatever you want to call them to individuals around the country, and they are passive. In other words, they're not involved in management. You know now that you're selling a security. So the SEC policy should be observed. You're selling a security, and you need to be aware of it first of all to follow the policy. Even if it's not a securities offering, you're raising money from a few active investors. The SEC policies do not apply. But they do still provide a useful framework for preparing your financial projections. Here's the SEC policy. First of all, it does not require financial projections. They're not required. So why would anybody go to the trouble to do them? because investors like to see them. This is a financial transaction for investors, so they want to know what the possibilities are, and they want to be told the truth. Now, but the SEC policy itself doesn't require financial projections, but they do require that the underlying assumptions be disclosed in writing. We'll talk about what assumptions are in just a moment. So that's part of the SEC policy. Underlying assumptions, put them in writing. Also, the SEC policy requires that those assumptions be reasonable. Now, that gives you a little play, but you need to be in position to argue that these assumptions are reasonable. And the SEC also wants these assumptions to be set forth in writing and explained in a way that in what they say enhances investor understanding. In other words, make it clear, easy to understand. One of the ways to do that, of course, is to use plain English and avoid industry jargon. So that's kind of a summary of the SEC policy. And I explained that in this panel discussion. And the SEC attorney said nothing. So I'm assuming to this day that he agreed. So let's talk about assumptions. The underlying assumptions upon which the numbers are based for financial projections consist of a series of specific statements. I like to use complete sentences, narrative statements that relate to the future economic performance of an investment upon which the numbers are based. And such statements are assumed to be true for the purpose of preparing the financial projections, which are projecting out into the future. And such statements are being made at the time of the preparation of the financial projections. Okay. Now, let me give you some examples of assumptions so you'll understand what I'm saying. And this is kind of in chronological order. So you start out, the first assumption that you need to make is how much money you raised. Again, we're talking about in the future, so we don't know for sure. But let's say your minimum for the offering is 500,000, your maximum is 900,000, and you pick 700,000 or for the amount of money being raised. So that's your first assumption. We successfully raised $700,000 to produce this film, this little low-budget independent film. And the second assumption is that we actually completed the film. We produced a film. Third assumption is that it's of a quality to be of interest to distributors. Fourth assumption is that you actually got a distribution deal. You made a deal with a distributor, and the deal basically said that the LLC, the producer group, represented by the LLC, is going to receive 50% of the film's net profits. That's an assumption. The only question is it reasonable? Okay. And then you can go on down from there and sort of project out with other assumptions. But that's an example of what the assumptions are. I usually end up with 20, 21 different assumptions going all the way down to the return for the purchase of a single investment. Now, step away from financial projections for just a moment. We're going to get to the numbers in a minute. But one of the things that's helpful, quite useful, in preparing financial projections is an understanding of the revenue streams that flow to the distributor, domestic and international. These are now. Let me tell you that every producer will disagree in some way about how this should be presented. And for good reason, because some producers have a pretty good idea of how their film's going to be distributed, whether it's going to be distributed or whether they even seek a theatrical release. And so these line items here in the revenue stream presentation will change, and you can change them. So you just need to have a reasonable basis for including it or presenting it the way you are. So this chart tries to show revenue sources for the distributor that come to the distributor, and then over on the right-hand side, a percentage of that market, so the domestic market. So in this case, this producer is saying, okay, we anticipate that about 10% of the revenue to the distributor, making part of the distributor's gross receipt, will come from a theatrical release. That's theatrical rentals, about 10% or less. And then the rest of it, what I do is collapse this presentation, this list of line items or revenue sources, and into one and just call them all ancillary. And another thing that people do today, quite commonly, is they'll put streaming instead of home video, but streaming is part of home video. It's just the largest part. It's kind of taking over that particular segment of the market. Uh, but if you collapse all of that into ancillary, then you might end up with, say, let's say 10% for theatrical rentals, and this is domestic, and the rest of it would add up to about 37%. And so you have 10% theatrical rentals, 37% ancillary for the domestic market. Then you go to the next revenue streams, and the same thing. You may have theatrical rentals, and you collapse the rest of it into ancillary, and you'll end up with about 12% for theatrical rentals and about 40% for the rest of it in the foreign marketplace. Now, with those numbers, that gives you an opportunity to take that average from the box office comparables and use it as an assumption for your film. So we'll look at that in just a moment. Now we're back to the financial projections. This is the bottom part. We have the assumptions that we've talked about, and now we're talking about the actual numbers. So this is the revenue sides divided up between revenue sources and deductions. So we'll have deductions next. So here are the numbers for revenue. Again, the numbers are irrelevant here. I'm just showing you the format. First of all, if you use three columns, poor, good, and excellent, it's clear to everybody involved that you're not predicting with certainty what the film's going to do in the marketplace. You're just saying if these assumptions are somewhat true, this is what might happen. These are the numbers for the poor performance column, and these are the numbers for the good performance column, and these are the numbers for an excellent performance. So clearly, you're saying, I don't know how it's going to work out, but these are our reasonable assumptions, and these are the numbers based on those assumptions. So here we would say, okay, domestic box office gross. In this case, this producer said, okay, we're going to assume that the domestic box office gross was 60% of the average for the comparables. And they used that as the assumption, I think, for the good performance column. So you get in one number. And then you can make another assumption and say, okay, we're going to think our poor performance is half of the good number, so that you can get that number just by saying dividing by 2. And on the other hand, we're going to assume, and the only question is, are these reasonable assumptions? We're going to assume in the excellent column that the domestic box office gross was twice as much as the good performance column. Okay, again, reasonable. Who knows? And so from there, if you go back then and look at that revenue stream chart, you can actually calculate the international box office and the worldwide box office gross from those few numbers, because you've got the percentages. And then, of course, you take out the exhibitor share and you end up with distributor rentals. Distributor rentals plus ancillary ends up with distributor gross receipts. I'm actually pointing with my finger here, which you can't see. So there's distributor gross receipts. Okay, so that's kind of that is a reasonable presentation with respect to financial projections. Now, then we get to the number side of the financial projections, and we take out the distributor fee, the distributor expenses, SAG residuals, and arrive at film's net profits or net proceeds, whichever you prefer. And then here's another assumption that would be in your list of assumptions, and that is that the net profits or net proceeds were split 50-50 between the distributor and the producer group, which might be the manager or the manager-managed LLC. And then in this particular case, this producer was offering 120% definition of recoupment. So 100 plus 20%, and in this case, that was 800,000, and so they put 840 across there, and that that was their recoupment. And then we allowed up to 1.5 million in creative deferments for this film, and we got to recoupment distributable cash, and the investor group share, and the earnings per unit. And this is what the investor wants to see, the projected ROI per LLC unit. The units in this case were 25,000. Okay, so that gets us all the way down to the return on investment for this particular offering. Now, a number of my clients over the years, some years ago, would come in sometimes with financial projections prepared by third-party preparers. Unfortunately, there were some problems with these projections, and so, for example, they tend not to disclose their assumptions. And as you recall, the SEC policy is you need to disclose your assumptions. The these third-party preparers of financial projections tend to use skimpy notes, not complete sentences, not complete lists of assumptions, and they tend to use industry jargon, which makes it harder for the investors to understand what they're talking about. And one of the reasons they do this, of course, is they don't want other people to know how they prepare their projections. I mean, they don't want to just give away the ball game. And so, in that sense, their projections are not really appropriate for securities offerings because they're not disclosing their assumptions, all of their assumptions. They're using industry jargon. They're not clear. And so, if you're doing a security, this is why it's important to know whether you're doing a securities offering or not. Okay. And so, here's some other things that third-party preparers tend to do. They typically fail to take the calculations all the way out to the purchaser of a single unit. They tend to stop at the producer level. And that's not what investors want to know. They want to know how much money they're going to get for the purchase of a single unit, you know. So you want to take it all the way out. The third-party preparers often are asked to prepare the financial projections too early. This is one of the reasons why they don't take it out to the investor purchaser of a single unit because they don't know what that deal is. The third-party preparer doesn't. And so these producers are sometimes asking the third-party preparers to prepare the financial projections too soon, before all the particulars are settled. In other words, as you go through and prepare a PPM, you're going to make a lot of decisions that have an impact on the financial projections. So if you do financial projections first, and then you change some of these particular bits of information that have an impact on the financial projections, you're going to have to go back and redo the financial projections. So we shouldn't do that. Now, that raises the question, well, when should you prepare financial projections? Well, they should not be prepared before the offering documentation is completed. And as I just said, there are too many decisions that are made during the course of preparing the offering documentation, and many of those decisions impact the financial projections. So a change in one or more of those decisions may also require a change in the financial projections. So try to avoid that if you can. Somebody out there is telling people, prepare your projections first. It doesn't make a lot of sense to me, but it's happening. Now, here's a little overview of what we tried to cover in this very limited sub-subject area relating to film finance and investor financing of independent film. About financial projections. So we're not trying to predict a film's performance with certainty. So kind of relax and get past that. We're only trying to make an estimate of the possible financial performance of the film based on reasonable assumptions. And there is, as we noted, there is a difference between box office comparables and financial projections. It's important to know that. Also important to know, if you're selling a security, the SEC has a policy regarding financial projections, and I suggest you follow their policy. Projections prepared by third parties tend to be problematic for securities offerings for the reasons stated, and the securities disclosure documents should be prepared before the financial projections. So that's our little summary of what we covered. Other topics in this series of videos that I'm doing and includes what's a security, so that helps you determine when you're selling the security and when you need to be concerned about securities compliance. And then the next video relates to securities compliance, where we kind of summarize different exemptions that are available. And then there's a disagreement or controversy about what to disclose and how much to disclose to these investors. And we go through that in that video. And then what happens if you fail to comply with securities laws? We cover that. There's another video on SEC notice filings, which is a topic that most people never heard of. And then I recently did one on finder's fees, which is a topic that comes up quite often in these offerings, and also one on business plans, which you would do with a few active investors. It's not even listed here, but I'm working on it. So that's the end of our presentation with respect to financial projections. I hope you found something useful there, and that you'll be interested in taking a look at some of the other videos as they come out. Thanks.